Investments and products with DSP Investment Managers. Anil, really appreciate you giving us your time today to talk about this topic. I think this entire methodology of factor-based investing is relatively new. In India, we don't have many funds out there. Yours is one such, and I think in the last 1 year, you've managed to beat most of the actively managed large cap funds as well. So why don't you start off with how exactly does the DSP Equal Nifty Fund invest? What does it look out for? What is the investment strategy it deploys?
Sure. Thank you very much for this unique opportunity to showcase this particular strategy. I will start with the key principle. So this fund meets the two basic principles of investments. When we talk about investing, we say that you should buy companies that are sector leaders, that have seen multiple business cycles and can ride through this kind of multiple cycles. That is the first basic principle. And the second is that portfolio should be well diversified across stocks and sectors. So now if we look at, suppose, the Nifty 50 stocks, these are all structurally the leaders of their particular sector, hence they are part of the Nifty. And what happens is that if you look at the weightage of the Nifty 50, because of the market capitalization based weightage, some of the sectors and some stocks are very heavily skewed. So we take the second basic principle and diversify well across both stocks as well as sectors. So in the sense, like, we can say this is a very simplest form of smart beta called equal weight, where all the stocks are having equal weightage. So we have got 50 stocks and each of them have 2% weightage. So what it results is that it creates a portfolio of stocks which are well balanced and have a same stock names, like let's say the Nifty 50, but with a very differentiated risk and return profile. Okay, because of the way in which it's a diversification involved into the portfolio management construction of the underlying stocks. So on the lighter side, I would like to give one small example. Because all of us in India, we relate to it very well, which is cricket. So we can think of this as a well-rounded cricket team, where rather than having a very heavy reliance on, let's say, the captain and let's say one star batsman and one star bowler. Here, let's say, for example, star batsman is out on a marriage holiday and the pitch is such that the pace bowler is not able to perform the magic. Then the team gets into a very troubled situation. Instead, assume that all players are given equal importance. There are 2-3 other spin bowlers also. All of the batsmen are quite good and each fielder is jumping behind each ball and stopping the runs. Automatically, that team, well-rounded team, is a much better always for potential to win. So similarly here, similar stocks like the Nifty, same stocks like the Nifty 50, but weighted in a more prudent and equal weighted manner. So that's how this simple smart beta strategy, easy to explain to investors, that there is nothing black box or nothing very complex formula which is running at the back end. But in simple way, in 2 minutes, you can explain the entire framework of this particular portfolio's investment.
Okay, that's very interesting. So it's almost like diversifying your portfolio as well in an equal manner. So let's say there's a little bit of underperformance in one particular sector or segment, the other one sort of makes up for it. So in a way, Anil, would you say that the volatility as well, or the movement in the NAV of this fund would also be relatively lesser? It will be less volatile than maybe a large cap fund, or let's just keep it with a large cap fund because that's the benchmark. Would you say that?
See, structurally, being an equity-oriented fund, Mubina, all equity has a risk involved. So there will be a volatility, no doubt. But yes, I like the way in which you put it, that in certain segments or in certain market movements where, let's say, there is a high beta fall and the fall is led by the very mega cap or large cap names, then yes, certainly this particular fund will be better protected. I'll give it with one particular example. Last year, like we saw in the 2020 beginning, like in March 2020, where the crisis of the pandemic hit everybody suddenly, and there was a sharp correction or the crash in the markets, broader markets. At that point of time, absolutely right, how you made the point in a very good way. This particular fund had protected the downside a little bit better as compared to some of the other large cap portfolios, or let's say compared to, let's say, Nifty 50 as the other benchmark in the context of large caps. Similarly, in the previous crisis also we had observed in 2008 after the global financial crisis, this particular fund was not in existence, but this strategy, which is on the Nifty 50 equal weight strategy, that particular index had done much better in terms of protecting the downside in that particular crash situation. And we all know that, from an investor's perspective, anything which can help little bit cushion the downside. Again, I'm repeating, I'm not saying that it does not have downside. It is equity risk. Definitely it will have correction, but it has a structurally slightly better potential for that.
All right. So in a way, it helps curb the losses that we could see, during a market down cycle. A very prominent one, and the most recent ones in our memory, was what we saw in March and April 2020 when the pandemic just hit. So Anil says that it protected the downside in a better fashion, compared to maybe the other funds out there. Anil, now, your particular fund has managed to beat all actively managed large cap fund. So, has this equal weightage strategy sort of aided you? And, many a times investors look at past performance as a guide for investing, especially retail investors. I think that's the most simplest way to go about choosing a fund, right? So looking at the market scenario as well, as we see markets are as well at record highs, and you're seeing a lot of momentum in small caps, mid caps. And I'm not asking you to predict returns here, because obviously that's not something you can do, but how do you see what sort of opportunity you see for the DSP equal Nifty fund?
See, I think in the context of the way in which market has recovered after the sharp correction, we have seen that there has been now a starting of a broad-based rally. So if we look at the pre-crisis situation, at that time, there was a very polarized rally. We can look at very few stocks which were driving the entire market. I mean, even within the large cap, there were only a certain segment of stocks which were driving the broader markets. Now, in the recovery rally, market has been very broad-based, and hence, as a natural reason, because this particular portfolio is a little bit more diversified, it is more heavier weightage in the other stocks which were very small weight in the Nifty 50. So it has done better in the recovery rally as well. So if we see from the lows of March 2020 after the sharp correction, and let's say 1.5 years after that, 1 year, 3 months after that, it has done extremely well. And a couple of reasons for that is if you look at sectoral weightage also, like this particular fund, the Nifty equal weight is overweight on auto, metals, pharma. These are the three big sectors where this fund is structurally overweight, the Nifty 50. And it is underweight on financials, let's say IT. So how the cycle has played out in terms of, let's say, the auto and metals, we have seen a very sharp rally in metals. We have seen autos in a good position after the recovery, where there has been a good consumption drive, there has been a good recovery post the crisis. So what we have seen, because of this sectoral allocation being overweight in this particular sectors also, it has helped a lot in the post-recovery rally. And we believe that structurally, if these kind of sectors would continue, then we would have some kind of a period of outperformance of this particular Nifty equal weight index to continue.
Okay, so it was also smart allocation across sectors that have managed to do very well. Autos, metals in particular, of course, have done extremely well, and thanks to the fund's overweight stance in that sector, we've seen a good outperformance come by. Now, we want to give a very holistic view of this fund, this method of investing to our viewers. So I just wanted to, understand from you, Anil, what could be the possible market conditions? Like you said, we are seeing a very broad-based rally right now, right? Where we are seeing good participation from every segment and sector across market cap. Under what market conditions could a strategy that the DSP Equal Nifty Fund deploys may not work?
Very good point. And we saw that also in the early period after we launched this fund in 2017, because what we saw is prior to the crisis, we saw about 18 to 20 months of period where there was a very steep polarization in the market. So what I mean by that is that if we see in future some pockets of time where only a few stocks are driving the market, then in such situations, this particular fund will always tend to underperform the broader markets or the broader large cap universe, because we will have underweight position in those stocks. Let's say today in Nifty 50, top weighted stock is about 10.5%, 11%. And in Nifty equal weight, it will have only 2%. So let's say that particular period of 2018 through early 2020, at that point of time, all my portfolio's underweight positions where I was holding only 2% and the benchmark Nifty 50 was holding 8, 9%, 10%, 11%. And they were the only stocks which were running. And in my portfolio, I was underweight. So in this kind of polarized market, if we have seen, like how we have seen in the past, if that comes up again, yes, this fund will definitely tend to underperform. However, in longer periods of time, if we even out such pockets or such periods, then yes, we have seen that this fund has a potential for a better risk-adjusted outcomes. Like you mentioned very correctly in the earlier point that it did have slightly better downside fall, and in the recovery, it had a slightly faster catch-up. So similarly, in the future, if we come across such cycles in the market, definitely this fund would be positioned that way. And I'll take one last point in the earlier, like how you mentioned about the comparison with the actively managed large cap funds. Sometimes what happens is that even the active large cap funds will definitely catch up, no doubt, because the portfolio manager, based on his or her investment philosophy, will realign to the particular portfolio's underlying market movements. But here what happens is that immediately as the changes are realigning, our portfolio in the equal weight fund are already positioned to benefit from such movements. And there is no human bias involved. To be very honest, if this fund did have human bias, might be as a fund manager, I would have taken some different call. Let's say in March 2020, when market was falling sharply, maybe I would not have had the courage that time to take an overweight position in, let's say, auto, metals, right? Because one would think that these are going to be negatively impacted. Might be I would have overweight in some other, let's say, IT or like maybe some part of like, financials or some non-balance sheet heavy, some services companies. But being a structure whereby it's a smart beta strategy without any human bias getting involved. Hence, the portfolio was positioned the way it was, and the overweight in these sectors helped in the outperformance.
Okay, I think, yeah, that's a great part, right? That you would perhaps eliminate the human angle that is involved in investing, which sometimes, at the end of the day, just as humans do, we do tend to falter over there. Great. It was great chatting with you, Anil. Thanks so much once again for giving us your time today on The Money Show, talking to our viewers about the DSP Equal Nifty Fund, the strategy it has deployed that has helped it, beat the returns of many actively large cap managed funds out there. The fact that, those are actively managed means that you'll be paying a manager fee as well, which in this case is a little lower comparatively. Thanks once again, Anil, for that.